Hey everyone, welcome back to the channel. If you're interested in options trading, today's video is going to be a great one. We're diving into a strategy called the poor man's covered call, a super popular and low risk way to get started with options trading. So if you're looking to make money with options but don't have a lot of capital to start, you're in the right place. So let's break it down. First things first, what is a poor man's covered call? It's a strategy that mimics a traditional covered call, but with a lower initial cost and lower capital requirements. Typically, when you sell a covered call, you own 100 shares of the stock and then you sell a call option on those shares. But for a poor man's covered call, you replace the 100 shares of stock with a long call option. This gives you the same exposure to the stock, but at a fraction of the price. So the long call takes the place of the normal 100 shares you have to own to sell a covered call. You're essentially buying a long call option with a longer expiration date, and then you sell a shorter term call option against it. This way, you get to keep a lot of the benefits of a traditional covered call without needing to spend thousands of dollars potentially to buy 100 shares of a particular stock. Let's break it down step by step with an example. Imagine you want to trade a stock like this one, AMD, which is currently priced at $107.62 per share. A traditional covered call would require you to buy 100 shares at $107.62, which is $10,762 in capital that you would have to tie up buying the 100 shares to start doing a covered call. That's a huge capital commitment. But with a poor man's covered call, you could instead buy a long call option with a strike price of $75, expiring almost a year from now, and this option would cost $3,950, which is still a lot of money, but it is 40% of what you would have to spend to do a traditional covered call. Now, instead of owning the 100 shares, you own this long call option here at 75, which gives you the same upside potential as owning the stock. Next, you sell a short-term call option on the same stock. Let's go ahead and take a look. So let's see for this upcoming week. I would try to sell something around the 20 to 25 delta range just to be safe. So for instance, if I were to sell a call, I would try the 113 because it has a delta of 0.18, so there's an 82% chance of profitability. So I would sell that call, and I would just keep selling calls like that every single week. So I would lower the cost basis. On this particular one, I wouldn't technically receive any premium for starting this because the $57 would be taken out of the $3,000 I'm paying for the long call. But after this week, then you could start collecting premium to earn back the money from the long option. By doing this, you're still generating income through the premium you receive for selling the short-term call, just like a traditional covered call. But instead of tying up the $10,700 to own the shares, you're only paying almost $4,000. And now you can collect premium on a fraction of the capital. It's pretty neat, huh? Now, as with any strategy, there are risks to consider before diving in. Let's go over some of the potential downsides of a poor man's covered call. First up, the long call you purchase could lose value. If the stock price doesn't move in your favor, the value of that long call option could decline, and you could lose the premium you paid for it, just like with any other option trade. If the stock price doesn't go up as expected, you might end up losing the entire amount that you paid for the long call. Second, by selling the short-term call, you're limiting your upside. If the stock price goes way above the price that you chose for your strike price on the short call, you will still be required to sell your stock at that price. So you can miss out on big gains if the stock rallies beyond that level. That's why it is essential to pick a strike price that gives you a reasonable balance between income and potential upside. Another risk is related to timing. You're selling short-term calls, so the expiration date of your sold call can catch you off guard if the stock price starts moving quickly. The shorter the time frame of the sold call means you need to pay close attention to the stock and be ready to adjust the position if things don't go your way. So, there are definitely risks involved in a poor man's covered call, but they can be managed if you understand the strategy and stay on top of your positions. Now let's talk about the benefits. There are some pretty solid advantages to using this strategy, which is why it's popular among options traders. First, the most obvious benefit is a low capital requirement. You're not tying up $10,000 plus to own 100 shares of the stock. Instead, you're only paying for the long call, which is typically much cheaper than buying the stock outright. This makes it a great strategy for people who want to get exposure to stocks without having to invest a lot of money up front, and especially if you're growing your account. Second, you can still generate income. By selling the short-term call, you're collecting premium income just like you would in a traditional covered call. This income can help offset the cost of the long call or boost your returns if the stock doesn't move much. And in the end, that's what you're trying to do with the short-term calls. You are trying to offset the cost of the long call so that by the end, about 30 to 45 days from expiration, you can sell the long call and you will have made a profit. That is the point of the poor man's covered call. Another benefit is a limited risk. The risk of a poor man's covered call is limited to the cost of the long call that you bought. Even if the stock price crashes, your loss is capped at that premium that you paid for the long call, which is far less than the potential loss from owning the 100 shares of the stock itself. Finally, there's more flexibility in managing the position. If the stock price goes up, you can roll your short call to a higher strike price and extend your position. If the stock price drops, you can decide whether to sell your long call or let it expire, giving you more control over your trades. So to wrap it up, the poor man's covered call is a fantastic strategy for traders who want to generate income with options but don't have the capital to buy 100 shares of a stock. It is lower risk, it gives you exposure to the stock's upsides and allows you to collect premium income. But just like any strategy, it comes with risk, especially if the stock doesn't move in the direction you expect, or if you're not careful about timing or paying attention to your position. Before jumping into a poor man's covered call, make sure to do your homework and understand how it works. And remember, always manage your risk carefully. If you found this video helpful, don't forget to like, comment, and subscribe. And drop any questions you have in the comments below. I'd love to hear your thoughts on this strategy. Thanks for watching, and I'll see you in the next video.